The U.S. Federal Reserve, often simply called the Fed, plays a pivotal role in managing the nation's economy. One of its primary responsibilities is to prevent or mitigate recessions, which are periods of economic decline marked by reduced industrial activity, lower consumer spending, and rising unemployment. The Federal Reserve uses various tools and strategies to manage recession risks and stabilize the economy. This video will explore the top 10 ways the Federal Reserve works to manage recession risks and promote sustainable economic growth. 1. Adjusting interest rates. One of the most well-known tools the Federal Reserve uses to manage recession risks is adjusting interest rates. When the economy begins to slow down, the Fed may lower the federal funds rate to make borrowing cheaper. This encourages businesses to invest and consumers to spend, helping to stimulate economic growth. Conversely, when the economy is overheating, the Fed may raise interest rates to prevent inflation. The careful balance between these adjustments is essential in avoiding recessions or reducing their severity. 2. Quantitative easing, QE. Quantitative easing, QE, is a non-traditional monetary policy tool that the Federal Reserve uses when interest rates are already low and cannot be reduced further. Through QE, the Fed purchases long-term securities, such as government bonds, from the financial markets. This increases the money supply, lowers long-term interest rates, and encourages lending and investment. By boosting liquidity in the economy, QE helps reduce the risk of a recession, especially during times of economic stagnation. 3. Forward guidance. Forward guidance is a strategy where the Federal Reserve communicates its future policy intentions to the public. By providing clear signals about its plans for interest rates or other policies, the Fed aims to shape expectations and influence economic behavior. For example, if the Fed signals that it plans to keep interest rates low for an extended period, businesses and consumers may be more likely to invest and spend, which can help stave off a recession. 4. Supporting employment. The Federal Reserve aims to achieve what is known as maximum sustainable employment. This involves keeping the unemployment rate low by encouraging economic growth. When the Fed identifies signs of economic slowdown or rising unemployment, it may implement policies such as lowering interest rates or engaging in QE to stimulate job creation. By ensuring that more people are employed and generating income, the Fed helps to maintain consumer confidence and spending, which are crucial for preventing a recession. 5. Managing inflation. Inflation, or the rise in prices of goods and services, is a key factor in the Fed's decision-making process. If inflation rises too quickly, it can erode purchasing power and lead to a slowdown in consumer spending. To prevent this, the Fed uses tools like interest rate adjustments and QE to keep inflation within a target range, typically around 2%. By managing inflation, the Fed ensures that the economy remains stable and avoids the risk of stagflation, where high inflation and high unemployment occur simultaneously. 6. Stress testing financial institutions. In times of economic uncertainty, the stability of financial institutions becomes a critical concern. The Federal Reserve conducts stress tests on banks and other financial institutions to ensure they have enough capital to weather economic downturns. These tests assess how well financial institutions can handle various economic scenarios, including recessions. By ensuring that banks are financially resilient, the Fed helps prevent a financial crisis, which can deepen or prolong a recession. 7. Supporting credit markets. The Federal Reserve works to ensure that credit markets remain open and functional, especially during times of economic distress. During a recession or financial crisis, lending between banks can freeze, leading to a credit crunch. The Fed can step in to provide liquidity to banks and other financial institutions, ensuring that they have enough funds to lend to businesses and consumers. This support helps prevent a sharp slowdown in economic activity, which could lead to a deeper recession. 8. Providing liquidity in times of crisis. During times of extreme economic distress, such as the 2008 financial crisis or the COVID-19 pandemic, the Federal Reserve acts as a lender of last resort. This means that the Fed provides emergency liquidity to banks, corporations, and even foreign central banks to prevent widespread financial collapse. By ensuring that there is enough liquidity in the system, the Fed helps stabilize the economy and reduce the risk of a severe recession. 9. Monitoring global economic conditions. The U.S. economy does not exist in a vacuum, and the Federal Reserve closely monitors global economic conditions. Economic slowdowns or crises in other parts of the world can have significant implications for the U.S. economy. For example, if there is a slowdown in major trading partners like China or Europe, it can affect U.S. exports and supply chains. The Fed takes these global factors into account when formulating its policies, ensuring that it is prepared for potential external shocks that could increase recession risks. 10. Collaborating with other government agencies. The Federal Reserve often works in concert with other government agencies, such as the U.S. Treasury and Congress, to manage recession risks. For instance, during a recession, the Fed may coordinate with fiscal policymakers to implement stimulus packages that provide direct financial support to individuals and businesses. By aligning monetary and fiscal policies, the Fed helps create a more comprehensive approach to economic recovery, reducing the chances of a prolonged recession. The U.S. Federal Reserve plays a crucial role in managing recession risks and ensuring the stability of the U.S. economy. Through tools such as adjusting interest rates, implementing quantitative easing, providing forward guidance, and collaborating with other government agencies, the Fed works to stimulate economic growth, maintain employment, and manage inflation. By carefully monitoring both domestic and global economic conditions, the Fed strives to mitigate the risk of recessions and minimize their impact when they do occur. In an increasingly interconnected global economy, the Federal Reserve's actions remain a critical component in ensuring long-term economic stability and prosperity for the United States and the world.